To become financially successful, you must start investing, but remember to invest smart. First things first, investing is a journey, and it's important to remember that Rome wasn't built in a day. You won't become an overnight billionaire by going all in with your investments. Instead, let's start small and take baby steps towards your financial goals. I get it, investing can be a bit intimidating, but fear not. With the right knowledge and strategy, anyone can become a successful investor. It's all about learning the ropes and making informed decisions. Now, the stock market can be a wild ride, filled with uncertainty, but don't worry, we're going to equip you with some key principles that can boost your long-term success. One of the things we'll explore is the importance of not holding on to underperforming stocks in the hopes of a miraculous rebound. It can be risky business. On the flip side, we'll also delve into the art of identifying good stocks that have the potential to keep climbing. By the time you finish watching this video, you'll have a solid understanding of the basics of investing. You'll have the knowledge and resources to begin crafting a profitable investment portfolio that aligns with your financial goals. Ride a winner. Peter Lynch is a successful investor who came up with a term called 10 baggers to describe stocks that multiplied in value by 10 times or more. And guess what? A big part of his success came from owning a small number of these incredible stocks. But here's the catch. Lynch's strategy wasn't just about buying these stocks and cashing out when they skyrocketed. No, it required discipline. He had the conviction to hold on to the stocks even after they had already increased in value multiple times. Why? Because he believed in their potential for even more growth. The lesson we can learn from Lynch's approach is that it's important to avoid blindly following strict rules or relying solely on arbitrary metrics when it comes to investing. Instead, we should consider a stock based on its individual merits and potential for growth. It's about doing your homework, analyzing the company's fundamentals, and assessing its long-term prospects. Sure, the appeal of quick gains may be tempting, but Lynch's strategy reminds us to have a more thoughtful and discerning approach. It's about identifying those hidden gems that have the potential to become 10 baggers and having the patience and conviction to hold on to them when others might be tempted to sell. Sell a loser. It's crucial to be realistic and face the facts when we encounter poorly performing investments. Here's the deal, there's no guarantee that these investments will magically rebound after a decline. Now, I know it can be tough to admit losses. We all want our investments to succeed and make us proud. But sometimes the smartest move is to sell off those underperforming investments to cut our losses and prevent further damage to our portfolio. It's about making a wise decision to protect our hard-earned money. When it comes to evaluating stocks, it's important to take a step back and assess companies based on their potential for future development. Sure, a stock may have taken a hit, but we need to ask ourselves if the company has a solid foundation and the potential to bounce back in the long run. Remember, it's not just about the current price of the stock. We need to weigh it against the company's growth prospects and whether the current price justifies that potential. It's about making a fair assessment and determining if it's worth holding on to an investment or if it's time to let go. Don't sweat the small stuff. Let's talk about the key mindset you need when it comes to investing. It's all about keeping the big picture in mind and not letting short-term volatility shake your confidence. Trust me, it's essential to focus on the investment's potential and trajectory. You see, active traders might thrive on minute-to-minute fluctuations in the market. But if you're a long-term investor, you shouldn't get caught up in the small details, like the slight differences between limit and market orders. It's not about obsessing over every little movement, but rather understanding that long-term success in investing spans over periods of years or more. You've got to zoom out and look at the broader trends and patterns. Sure, the market may have its ups and downs, but what really matters is the overall direction and growth potential of your investments. Don't let short-term noise distract you from the bigger picture. Having confidence in your investments and their long-term trajectory is crucial. It's about understanding the fundamental value and future prospects of the companies you've invested in. Do your research, analyze the market trends, and have faith in your investment thesis. Remember, investing is a long-term game. It's not about getting swayed by every market hiccup or trying to time the market perfectly. Instead, it's about having a solid strategy, diversifying your portfolio, and staying committed to your long-term goals. Pick a strategy and stick with it. It's crucial to find an approach that resonates with you and stick to it, rather than jumping between different strategies. You see, constantly shifting between different approaches can turn you into a market timer, and that can be quite risky. Timing the market is a challenging game, and even the most seasoned investors struggle with it. Instead of trying to predict short-term market movements, it's better to focus on a consistent, long-term strategy. Take Warren Buffett, for example. He's a legendary investor known for his success in the stock market. One of the keys to his achievement is sticking to a value-oriented strategy. Buffett looks for companies that he believes are undervalued based on their intrinsic worth. By focusing on the underlying value of the business, he aims to avoid risky investments and minimize the potential for significant losses. Now, I'm not saying that Warren Buffett's strategy is the only way to go. There are different approaches to investing, and it's essential to find one that aligns with your goals and values. The point is to choose a philosophy that makes sense to you and then remain disciplined in following it. By sticking with a single philosophy, you'll develop a deeper understanding of your chosen approach, and you'll be able to make more informed investment decisions. It's about having a consistent strategy that you believe in rather than constantly shifting gears based on market trends or hot tips. Focus on the future and keep a long-term perspective. When it comes to investing, it's all about anticipating future events. While historical data can give us some insights and help us make predictions, you must remember that it's never a guarantee of what lies ahead. I remember reading Peter Lynch's book, One Up on Wall Street, back in 1989, and he had some great wisdom to share. He talked about the importance of looking beyond the surface and not just asking ourselves, how can this stock possibly go higher? It's easy to doubt and hesitate when we see a stock's price already soaring, like when he mentioned the example of Subaru's price increasing by a factor of 20. But here's the thing, Lynch didn't just focus on past results, he looked at the fundamentals, the underlying factors that determine a company's value. And he saw that Subaru still had room to grow. Despite the significant increase in price, he believed it was still inexpensive relative to its potential. And guess what? He made a wise investment decision and ended up earning a 7-fold profit. That story reminds us of the importance of investing based on prospective results rather than solely relying on past performance. We shouldn't be swayed by short-term market movements or get caught up in the allure of quick gains. Sure, active trading can sometimes make money in the short term. There are individuals who specialize in timing the market and making quick trades. However, it's important to note that active trading comes with its own set of risks. It requires constant monitoring, extensive market knowledge, and the ability to make split-second decisions. For beginners or those without extensive experience, a more prudent approach is to adopt a buy-and-hold strategy. Be open-minded. It's easy to get caught up in the excitement of well-known and widely celebrated companies. We all know those fantastic enterprises that have become household names and have delivered impressive returns to investors over the years. But here's something interesting to consider. There are thousands of lesser-known enterprises out there that have the potential to become the next big thing. These are the hidden gems that might not be in the spotlight yet, but have the possibility to grow and evolve into blue-chip companies. Now, I'm not suggesting that you should exclusively invest in small-cap stocks. It's important to have a well-diversified portfolio that includes a mix of different types of investments. Beyond the well-known companies that make up popular indexes like the Dow Jones Industrial Average, there are numerous outstanding businesses out there that may not be as widely recognized, but still hold great potential for growth and profitability. The key takeaway here is that it's important to explore beyond the mainstream and consider a variety of investment opportunities. While the popular and widely followed companies certainly have their merits, there are other hidden gems waiting to be discovered. By doing thorough research and analysis, you can identify those lesser-known but promising enterprises and potentially capture even greater returns in the long run. When it comes to investing, there are a few important things to keep in mind. Let's break it down. Start with a personal financial roadmap. Take a moment to sit down and honestly evaluate your finances before diving into investments, especially if you're new to the game. The first step towards successful investing is understanding your goals and your tolerance for risk. It's important to remember that your ability to make profits from investments is still being determined. However, with some learning about saving and investing, and by following a smart strategy, you can achieve financial security and enjoy the rewards of managing your money wisely. Assess your comfort zone with risk. It's crucial to recognize that every investment carries some level of risk. Whether you're considering stocks, bonds, or mutual funds, there is a chance of losing some or all of your money. Unlike bank deposits insured by the government, investments in securities aren't protected. Even if you purchase your investments through a bank, your principal, the money you invested, could be at risk. However, taking on risk also offers the potential for higher investment returns. If you have a long-term financial objective, carefully investing in riskier assets like stocks or bonds can be more profitable compared to cash equivalents. On the other hand, if your goals are short-term, focusing on cash assets might be more suitable. Just be aware that inflation risk is a significant concern for cash-equivalent investors. Avoid overinvesting in a single stock. It's wise to be cautious when putting a large portion of your investment into any individual stock. It's all about diversification to reduce your risk. By spreading your investments across different assets, you can minimize losses and stabilize your investment returns without sacrificing potential gains. Investing heavily in any single stock exposes you to significant financial risk. If the stock takes a nosedive, you could lose a substantial amount of money. Build an emergency fund. It's prudent for most investors to set aside some cash in a savings account to cover unexpected expenses or sudden job loss. Many people aim to save up to 6 months' worth of salary to ensure they have a safety net in case of emergencies. Consider dollar cost averaging. Dollar cost averaging is a smart strategy that helps you avoid investing all your money at once. Instead, you gradually invest additional funds over time. The beauty of this approach is that it allows you to buy more when prices are low and less when they're high. So if the market is unpredictable, individuals making lump sum contributions to their individual retirement accounts towards the end of the year or in early April may want to seriously consider dollar cost averaging. Remember, investing is a journey that requires careful consideration and planning. By taking these factors into account, you can navigate the world of investments with more confidence and potentially achieve your financial goals. If you found this information helpful, please give us a thumbs up, turn on the notification bell, and subscribe to our channel for more tips. Thank you for watching.